Hello, friends. I receive tons of questions on how I approach my trading. Finally, this video will answer these questions. This video will explain the concepts and theory behind my daily stock picks. I wanted to create this video anyway to give more meaning to my daily stock pick videos. By combining the theory presented in this video and the application of this theory shared through my daily stock pick videos will make it a very powerful and unique learning experience for new and struggling traders. I say unique because we all know it is easy to speak to market data in retrospective, but only a solid theory and its application can offer positive results in future. In this video, we're going to take a journey on a road less traveled by eliminating much about trading which is not true. We are going to unravel some tangled ideas. So without further ado, let's dive in.
You may be a stock trader, or a forex trader, or an investor, day trader, beginner, or professional trader. Everyone will find something in this video that has the potential to turn you into a consistently successful trader, or to dramatically improve your performance. Beginner or struggling traders will learn how to trade with confidence. They will learn about trading essentials to fill in the gaps of knowledge they may not have realized they have. Advanced traders of any asset class, securities, and timeframes will discover the power of self-reflection. Whether already making consistent profits or still struggling, every trader will value this video. There are too many moving parts to trade in financial markets. This presents an immense learning challenge for beginning and struggling traders who want to learn and grow. Here are a few reasons behind this challenge. We are living in an era of information overload, where finding relevant content is becoming increasingly difficult. We're constantly bombarded by information from chat rooms, emails, online communities, newsletters, Twitter and Facebook updates, and more. The new traders try to process this information because they often feel the need to study everything available. They will typically go on a knowledge quest, learning about trend lines, chart patterns, support and resistance, candlesticks, market profiles, point and line charts, Elliott waves, Fibonacci retracements, oscillators, relative strength, stochastics, and many more technical tools too numerous to mention. There are so many different ways to profit in financial markets that it becomes difficult to sort the overwhelming number of strategies, trading styles, and markets to begin with. As a result, the new traders become confused. Information overload is possibly the biggest distraction to experienced traders who are struggling in trading. They keep reading, watching, trailing every new strategy they see that appears to be more holy grail than the last. It gets to the point that they lose sight of the very basics of trading. So how to solve this problem? The answer is through clarity of mind. Clarity of mind comes when we think simple and are aware of what is really important to us and let go of all the rest. But in trading, how do we know what is really important to us and let go of all the rest? The answer is by guiding new and struggling traders through a structure of trading. The structure will help in steering them in the right direction and best prepare them for the journey ahead. And that's what this video is all about. Kamran Syed has created a trading framework which covers all foundational aspects of trading. This framework will put any beginning or struggling trader on the path of a process to be a consistently profitable trader. This framework has evolved over Kamran's trading career spanning 15 years. That's 15 years of him making mistakes and learning from them. The underlying principles of this framework are based on Kamran's learnings. For example, the most profitable strategies are the simplest ones. More information leads to confusion and poor trading performance. Have a checklist of things you look for. Keep the list simple. The rest of the stuff happening is just noise, so ignore it. Remember, your winning ratio is going to be around 45% to 55% anyway, so spend less time trying to be right and more time on sizing your positions properly and managing your risk. Let me give you a preview of this framework before we dig any deeper. This framework consists of 4 foundational aspects of trading. 1. Market uncertainty. The financial markets are inherently uncertain. However, you don't need certainty to make money. Suppose I flip a fair coin. If you correctly guess which side it lands on, you get $2. Otherwise, you give me 1. Would you play this game? The math tells us that you should play the game. If we were to flip the coin many, many times, you would almost certainly make money. Note that the game is inherently uncertain, since there is no way you can predict which side the coin will land on with perfect accuracy. You are only hoping that, over the long run, the risk-reward will tilt in your favor. More on this topic later in this video. 2. Trader's mindset. You cannot control market uncertainty, but you can control the mind you bring to the management of uncertainty. This is personal power, and we will talk about it more shortly. 3. Trading plan, including a trading edge and money management system. You can fill your mind with plenty of information, but without a good trading plan and the discipline to stick to it, you will never be profitable. Money management is crucial if you want to have any hope of becoming a consistently successful trader. Your trading edge is the heart of your trading plan. As we will see in this video, trading is all about probability. It is the art of correctly applying a set of rules and allocating the probability of that event to result in success. 4. Trading goal. A trading goal is not just a directional device. It works as a source of inspiration and motivation and acts as a fuel to fire. It also acts as a glue for holding the other aspects of the framework together by ensuring mutual alignment and reinforcement. Trading is not like buying a t-shirt. One size does not fit all. Each trader has their own personality, their own personal schedule, their own appetite for risk, their own pain threshold, and their own bankroll. This makes trading a very personal business. What works for one trader may not work for another. When we take a deeper dive into this framework, we will find out that this framework accommodates for the variations that are found in individual trading styles. This makes this framework very empowering. As you can see, there are a lot of overlapping areas in the framework between the 4 circles. It shows the 4 foundational trading aspects are interlinked, impacting one another. As I talk about each of these 4 foundational aspects in detail, there may be some repetition to make my point clear. These are crucial concepts to understand, and I want to make sure I drive the point home in your minds from all possible angles. As every carpenter knows, sometimes you have to hammer a nail from different angles to drive the point home. We need some form of specific technical strategy to define market opportunities and allow us to recognize them. However, in this video, we don't offer specific technical strategies. Instead, we focus on the understanding and accepting of the realities of trading. Technical strategies are not the defining factor that separate the consistent winners from everyone else. We will talk more about this topic later in the video. Application of the framework in real world. In the spirit of applying what Kamran is preaching, as some of you may know, beginning of 2019, he has started posting daily YouTube videos in which he picks stocks to trade for the next trading day. He does it in a very transparent fashion. His daily picks and the subsequent trading is based on this very same framework. This would be an effective way to learn and grasp important concepts and principles of the framework we are sharing in this video. Let me point out how Kamran applies each aspect of this framework to his daily trading. 1. He accepts what the market gives him when he closes his positions every day, profit or loss. 2. He follows his trading plan every day, like a broken record. His trading plan acts as a decision-making tool throughout his trading activity, from the time he picks the stock to when he opens his position to the closing of his position. 3. He has complete faith that his trading edge will produce profits in the long term, and he is not worried about short-term losses whenever they occur. 4. For money management, 1. Kamran diversifies by trading multiple stocks daily. 2. Whenever Kamran's edge appears, he uses a fixed allocation of money for his daily trading, because he doesn't know if his next trade will be a winner or a loser. He equally distributes his trading capital among the stocks he trades. This ensures that he manages his position sizes correctly. What it means that he avoids a situation where he may have to take a larger loss due to a bigger size or a smaller win on a smaller size. Because Kamran has faith in his trading edge, and he knows if he trades every time his edge appears with the same size, he will end up profitable. 3. Kamran uses stop losses. 5. He has a clear trading goal. He has it in writing, and it is a realistic goal based on the historical performance of the system Kamran uses. 6. The overall approach of his daily trading is a reflection of the trader's mindset. Kamran thinks in probabilities and accepts the risk, and doesn't get negatively emotional when he loses money. In this video, when we refer to successful trading or successful trader, we mean getting consistent results as a steadily rising equity curve with only minor drawdowns that are the natural consequences of edges that didn't work. In this video, we have tried to lay out very logically and in an easy way to follow how there is a method to the madness and what it takes to become a consistently successful trader. We are hoping this video changes how you look at trading. We are hoping, after watching this video, you will say, "There's the trader I used to be before," and another trader after watching this video. It has completely changed the way I see markets for good. This framework will improve your trading, provided you spend some time understanding concepts shared in this video. This wraps up the introduction section. Next, we will look at this framework more closely by examining each of its 4 foundational aspects one by one, starting with market uncertainty. While we may see a reason to buy a particular stock, others may have reasons to sell. Also, there are traders on the sidelines waiting with their reasons to buy or sell. Because anyone can decide at any time that can alter the direction of a stock or on any time frame, we can never predict the future. Humans love to have certainty in everything they do in life, from their job situation to their relationships. And from a young age, they are conditioned to believe that this is how things should be, with sayings such as, "Go to school and then get a good job," or "Find a nice boy or girl and get married," etc. Any uncertainty can cause real stress. This is why it is avoided in everyday life as much as possible. Humans love to have everything in control and know precisely what the outcome is of all situations where possible. The simple fact about the markets is that you don't have control, and if you place a trade, the outcome is uncertain. No matter how great any trade looks or how sure a winner you think it will be, the outcome is still uncertain. It is this uncertainty that consistently successful traders have worked out by learning how to trade with and not trying to fight or control. Most things about the markets have uncertainty, and this is why humans don't make great natural traders. Where traders usually fall is looking and craving for certainty in the markets, which causes them to make irrational decisions. Uncertainty is what traders need to get used to dealing with, because it is managing the uncertainty that is the key to a successful trading mindset. If a trader cannot learn how to be at ease with uncertainty and accept it, they will struggle to make money consistently. For this reason, many of our beliefs, attitudes, and principles that work so well in our day-to-day activities, but they do not go well when we are dealing with the financial markets. When dealing with the financial markets, like stock market or forex market, these beliefs, attitudes, and principles need to be different to generate profits from our trades consistently. Many of the thinking patterns which adversely affect our trading are a function of the natural ways in which we were brought up to think and see the world. These thinking patterns are so deeply ingrained that it rarely occurs to us that the source of our trading difficulties is internal, derived from our state of mind. In real life, people are not accustomed to losing. If your finger gets trapped inside the elevator hole, you would probably turn on the alarm, stop the entire building from using the elevator, and call the fire brigade to help save your finger, right? You wouldn't just cut it off and continue with your day, because in real life, fingers don't grow back. In the market, if your finger gets caught and you try to save it with your other hand, the other hand will get trapped as well, and you will lose both hands. So the solution would be just to cut your finger, as in the markets, fingers do grow back. Finger analogy is, as you may have figured, is when your position is starting to go against you. If you sit there and wait for it to bounce back, hoping you wouldn't lose your money, you will lose more money. And the only solution is to cut your losses early on, and have confidence that you will be in profit next time, when you will be compensated for your losses and be in profit overall. So this response has to be learned, as we have been conditioned to behave and think differently. That's why almost 95% of the traders fail to make consistent profits in the financial markets, because they use the same principles they apply to other areas of their day-to-day life, and it works so well for them. We can think of a financial market as a different planet, because it requires a trader to have unique sets of beliefs, attitudes, and principles to generate profitable trades consistently. Let's pick stock market as an example. Of course, this example would equally apply to any of the other financial markets like forex market. We can think of stock market as another planet, a planet that operates under a set of different rules and laws compared to Earth. Let's zoom in on this planet, and let's call this planet Planet Stock Market. Uncertainty is a normal way of life on Planet Stock Market. People living on this planet fully accept all possible outcomes of uncertain events with no internal conflict. They understand either the outcome will come in their favor or not. They accept any outcome because they believe that there is no way to predict the outcome of uncertain events. They also believe that there is randomness among the outcomes of uncertain events. Recognizing the randomness inherent in the outcomes of each uncertain event eliminates the egotistical need to be right. To help manage the uncertainty objectively, people of this planet have developed their edges, which gives them a higher probability of success. For this reason, they have trained their minds to think in probabilities. For example, on Earth, our day-to-day activities have almost a certain outcome. We are in better control of things. For example, if we have to drive back from our work to home, we get from our workplace to home with a high level of certainty. Now, imagine you lived on the planet stock market where day-to-day activities have a high level of uncertainty. Say you need to get to your home from your office after a long day of work. The only option is to take a cab. Now, imagine you standing on a busy street trying to catch a cab to take you home. The street is full of cabs. Remember, life on Planet Stock Market is highly uncertain. It means a cab which you are expecting to take you home may take you somewhere else. However, you being the resident of this planet know very well how to manage uncertainty, since uncertainty is a way of life here. You are at ease with uncertainty, as the people living on this planet have had a lifetime of conditioning to accustom to manage uncertainty. So you stop a cab on the street, get inside the cab, and tell the driver where you're going. The driver starts driving. You start looking outside the window to make sure the cab is driving in the direction of your home. As long as the cab is driving in the right direction, you are okay with it, and you continue to keep looking outside until you reach home. When you arrive home, you have accomplished a task that had a high level of uncertainty. Now, imagine the other case. You need to get to your home from your office. You're standing on a street trying to catch a cab to take you home, so you stop a cab on the street, get inside the cab, and tell the driver where you're going. The driver starts driving in the direction of your home. After a while, the cab takes a route which is not your home route. As soon as you notice it, you stop the cab and get off from it and start looking for another cab. You continue this process until you reach home. Here is a limitation. You can carry a maximum of $100 cash. The cabs only take cash. They will charge you anywhere between $10 and $20 as soon as you get inside the cab, and there is no refund regardless if they take you home or not. This means if you run out of cash before reaching home, you will need to walk to your home, which can take several hours. The further you are from home, the higher the cab charges. To help the inhabitants of the planet's stock market deal with uncertainty better, there are tools available that associate a probability value of success to their uncertain tasks. In our example of taking a cab to home, you can get glasses which, when you wear them while standing on the street to catch your cab for your home, will display a probability number for each cab to take you home successfully. The edge with the glasses guarantees you will get home if you take the cab 7 out of 10 times. It means if you follow your edge correctly and manage the risk of running out of cash effectively, you will reach home without walking. In other words, the glasses provide an edge to make a better choice of picking a cab to reach your destination quickly and without running out of money. Since the inhabitants of planet's stock market are born and raised with these uncertain conditions in their day-to-day life, they have accounted for the uncertain events as a normal way of life, and hence they do not feel betrayed or rejected or get negatively emotional if an outcome does not go in their favor, because they keep their expectations realistic. Instead of getting negatively emotional with an unfavorable outcome, they deal with the uncertainty in a more objective way to have the odds of success in their favor. 1. They have a mindset which accepts the risk. 2. They have a mindset which thinks in probabilities because they know they can't predict the future. 3. They have an edge, like glasses in the example. 4. They understand there is a random distribution between uncertain events. 5. They get out of an uncertain event as soon as they realize the outcome will not be in their favor to stay efficient in their money management. 6. They accept that they have control over the process of managing uncertainty, but no control over the outcome. Please keep this example of living on an uncertain planet in mind when trading in financial markets. To be consistently successful traders, we need to act like people on that planet to manage the uncertainty of financial markets successfully. The market environment, just like the uncertainty on that planet, is diametrically different from our real-life situations. It's unpredictable, and we need a different mindset to overcome the challenges of surviving in such an uncertain environment. That's why mastering trading psychology is so important. It is the way to help you find the right mindset to manage the unpredictable nature of the markets. Next, we will focus on the trader's mindset. Much like when an athlete prepares his mind for a performance, a trader needs to be intentional about the mind he brings to trading. Without preparing the mind for the work of trading, the trader is at a huge disadvantage. Even faint levels of fear, excitement, or euphoria can easily sabotage the mind that can effectively manage uncertainty, probability, and the unknown. In this section, I will share how Kamran has combined the work of two famous trading psychologists, Randy Howell and Mark Douglas, to build a trading mind in order to achieve consistent profits. Randy Howell's work goes deeply into biology and risk from a more traditional standpoint, and Mark Douglas's work does a great job of explaining the fundamental execution skills that you need in order to be a consistently successful trader. According to Randy Howell, no matter how hard you try, no matter how long you search for the secret that will open the door to the next level, negative emotions still sabotage your trading mind at just the wrong moment. Keeping a clear head is easy when there is no skin in the game. But the moment that real capital is put at risk with an uncertain outcome, everything changes. Suddenly, primitive survival instincts kick in and ambush the rational mind. We have inherited these primitive survival instincts from our ancestors when they were cavemen thousands of years ago. Their brain had to stay on the lookout at all times because they were surrounded by many dangerous forces, so it developed a way to stay super sensitive and pick up on danger. That's all great for cave times, but that same alert system is still in place today in our brains and keeps us looking out for danger, even when the stakes are quite a bit lower. We bring the same caveman brain and instincts into trading every time our real capital is put at risk with an uncertain outcome. This mindset is where the trouble begins. Fear of uncertainty and the urge to chase opportunity then compromise the required disciplined mind. Traders need to stop using the beliefs which are deeply rooted in the survival instincts of our species and instead create new beliefs to maintain a disciplined mind so they can use their knowledge in the heat of the moment. The more the trader tries to control his or her emotions, the more seem to pop up at all the wrong times. But the reverse is also true. By understanding emotions, traders learn how to use emotions to create the mind that performs effectively under the conditions of uncertainty and capital risk. Effectively managing emotions are front and center to your success in trading. The mind you trade with is rooted in your emotions that arise when you are engaging the challenges of managing uncertainty. Mastering emotions as a response to engaging uncertainty is simply essential. Until this is understood, there will always be a mental block to your capacity to trade effectively. No amount of knowledge, hard work, or success thinking is going to overcome the obstacle of emotional ignorance. The brain interprets uncertainty as a potential threat to survival, particularly with capital at risk. This is the brain you brought to trading, but it is not going to be the one that brings you success in trading. Emotions are only doing their job that they were designed to do. The moment that loss of control over outcome with capital at risk is real, your survival instincts kick in, almost disabling your thinking capability. Your brain becomes so locked up into a very narrow definition of success that it cannot see the need to adapt to a new way of perceiving the world in which it lives. This narrowing of focus of attention becomes the mental block to your growth as a trader. You're locked in and don't even know that you are locked in to a self-limiting tunnel vision. You see only through the eyes of your survival instincts and emotional brain when exposed to the challenges of uncertainty and risk. Until this genetically encoded sequence is changed, your trader's knowledge and skill is lost at the very time that it is needed most. Changing your emotions that give rise in your mind in the midst of uncertainty when you trade and your capital is at risk is the name of the game. Until you unlock this perceptual barrier, you are stuck with the default programming of your survival instinct. The more you resist and try to force your will, the stronger the emotional reaction will be. Remember, to your emotional brain, it is a life or death situation. In such emotional urgency, the thinking mind becomes slave to the emotional brain because it is hijacked by the overriding power of survival instincts. This is simply the default programming of your survival instincts, triggering fear and anger. Until this reactive pattern is observed, deconstructed, and redesigned for the management of probability, you will stay stuck in a mental and emotional survival stalemate that sinks your capacity to manage uncertainty with an effective mind for long-term profitability. Our mind becomes vulnerable when dealing with uncertainty. Now, for success in trading, a new belief with a different emotional configuration is needed when exposed to the challenges of uncertainty. The hot wiring between uncertainty, vulnerability, and confusion has to be decoupled and replaced with a new emotional response to the perceived dangers of uncertainty and capital risk that will result in a patient and disciplined mind. This requires a completely different way of perceiving the world in which you engage. Fortunately, your brain is primed for this adaptation. Once you truly realize that the mind that you brought to trading is not going to work to produce success in trading, how do you go about changing your perception, your personal narrative, for managing market uncertainty for long-term profitability? To answer this question, Mark Douglas suggests you need to create new beliefs in your subconscious mind that automatically determine your perceptions, expectations, behavior, and emotional state in regard to engaging the markets for long-term profitability. You also have to turn off beliefs that can potentially sabotage your investing endeavors. If we're mindful and intentional about the thoughts and realities we want to cultivate, we can vastly change our brains. It's all about creating new beliefs, and these new beliefs are the light at the end of the tunnel. How do you create new belief systems? By intentionally becoming aware of new things we didn't notice before and looking at what we already know in a new way. In order to create a new belief, 1. The new belief must be believable, and 2. The new belief must correspond to what you want in life. For this new belief to be believable, first we must find evidence that the new belief works effectively. That is, it produces consistent profits in uncertainty. So then the question is, how can someone produce consistent profits from an event that has an uncertain outcome? To answer this question and find evidence for the new belief, all we have to do is look to the gambling industry. Corporations spend vast amounts of money, in the hundreds of millions, if not billions of dollars, on extravagant hotels to attract people to their casinos. Casinos make consistent profits day after day and year after year, facilitating an event that has a purely random outcome. The new belief to be created is, you need to trade like a casino. In his book, Trading in the Zone, Mark Douglas shares 5 fundamental truths about this new belief, you need to trade like a casino. Before we get into these 5 fundamental truths, let me share with you what is meant by trade like a casino. Casino owners and consistently successful traders understand that events with probable outcomes can produce consistent results if you can get the odds in your favor and there is a large enough sample size. Consistently successful traders treat trading like a numbers game, similar to the way in which casinos approach gambling. To illustrate, let's look at the game of blackjack. In blackjack, the casinos have approximately a 4.5% edge over the player, based on the rules they require players to follow. This means that over a large enough sample size, that is, number of hands played, the casino will generate net profits of 4.5 cents on every dollar gambled on the game. This average of 4.5 cents takes into account all the players who walked away big winners, including all winning streaks, all the players who walked away big losers, and everybody in between. At the end of the day, week, month, or year, the casino always ends up with approximately 4.5% of the total amount gambled. That 4.5% may not sound like a lot, but let's put it in perspective. Suppose a total of $100 million is gambled collectively at all of a casino's blackjack tables over the course of a year. The casino will net $4.5 million. What casino owners understand about the nature of probabilities is that each individual hand played is statistically independent of every other hand. This means that each individual hand is a unique event, where the outcome is random relative to the last hand played or the next hand played. If you focus on each hand individually, there will be a random, unpredictable distribution between winning and losing hands. But, on a collective basis, just the opposite is true. If a large enough number of hands is played, patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. Even though you don't or couldn't know in advance the sequence of wins to losses, you can be relatively certain that if enough hands are played, whoever has the edge will end up with more wins than losses. The degree of certainty is a function of how good the edge is. It's the ability to believe in the unpredictability of the game at the micro level, and simultaneously believe in the predictability of the game at the macro level that makes the casino effective and successful at what they do. Their belief in the uniqueness of each hand prevents them from engaging in the pointless endeavor of trying to predict the outcome of each individual hand. They have learned and completely accepted the fact that they don't know what's going to happen next. More important, they don't need to know in order to make money consistently. Because they don't have to know what's going to happen next, they don't place any special significance, emotional or otherwise, on each individual hand, spin of the wheel, or roll of the dice. In other words, they're not burdened by unrealistic expectations about what is going to happen, nor are their egos involved in a way that makes them have to be right. As a result, it's easier to stay focused on keeping the odds in their favor and executing flawlessly, which in turn makes them less susceptible to making costly mistakes. They stay relaxed because they are committed and willing to let the probabilities, that is, their edges, play themselves out, all the while knowing that if their edges are good enough and the sample sizes are big enough, they will come out net winners. Consistently successful traders use the same thinking strategy as the casino. Not only does it work to their benefit, but the underlying dynamics supporting the need for such a strategy are exactly the same in trading as they are in gambling. Let me now share with you Mark Douglas's 5 fundamental truths about this new belief that we are attempting to create in our mind. 1. Anything can happen. It means you have no control over the market. 2. You don't need to know what's going to happen next in order to make money. You don't need to be a psychic or try to predict the market. This is not to say that you cannot predict what the market will do next and be correct, only that you don't have to, and that by trying to predict, you attach yourself to the need to be right and the associated ball and chain. 3. Wins and losses are random. You will never know when a trade will be a winner in advance. 4. Your edge is nothing more than a higher probability of one thing happening over another. Your edge is no guarantee of a winning trade, just of winning over time. 5. Every moment in the market is unique. Just because a similar trade won last time does not mean it will this time. And by treating each trade as totally unique, you can see the truth of the trade without relating it to what happened last time. Mark Douglas, through his work, attempts to convince people like us that trading is just a simple game of probabilities, not much different from pulling the handle of a slot machine. At the micro level, the outcomes to individual edges are independent occurrences and random in relationship to one another. At the macro level, The outcomes over a series of trades will produce consistent results. From a probabilities perspective, this means that instead of being the person playing the slot machine, as a trader, you can be the casino if 1. You have an edge that genuinely puts the odds of success in your favor. 2. You can think about trading in the appropriate manner, that is, Mark Douglas's 5 fundamental truths, which we just covered. 3. You can do everything you need to do over a series of trades. Then, like the casinos, you will own the game and be a consistent winner. Once this new belief to trade like a casino is integrated into your trading mindset, then there will be no fear, resistance, or distracting thoughts. On the other hand, this new belief is going to create a head-on collision between your desire to think objectively in probabilities and all the forces inside you that are in conflict with this desire. The amount of difficulty you have in integrating this new belief in your trading mindset will be in direct proportion to the degree to which these conflicts exist. Don't be surprised if, initially, you find integrating this new belief in your trading mindset virtually impossible. How should you handle it? Monitor yourself and use the technique of self-discipline to refocus on your objective. Write down Mark Douglas's 5 fundamental truths and keep them in front of you at all times when you are trading. Repeat them to yourself frequently with conviction to replace the emotions of fear in your mind. Repetition of the fearful activity is well illustrated by the analogy of a horror movie. Think back to the first time you saw a good horror movie. Because you had never seen the film, the first time you saw a horror scene in it, you were probably terrified. However, after the 20th viewing, the same stimulus produces a different response in most people, like laughter. Repetition of the stimulus has desensitized you to that which was originally terrifying, because we now know exactly what will happen next. Repetition, research, and under-leveraged trading deactivate one of our greatest fears, fear of the unknown. Although we cannot know the outcome of a particular trade in the markets with the same certainty as that of a horror film, repetition of the execution of uncomfortable, positive expectancy trade setups can nevertheless deactivate our fear of the unknown outcome, gradually replacing it with confidence in our edge. Don't try to deny the existence of conflicting forces in your mind. They are simply parts of your psyche that are arguing for their versions of the truth. When this happens, refocus on exactly what you are trying to accomplish. Follow the rules of your trading plan as best you can. Doing exactly what your rules call for while focused on your new belief will eventually resolve all your conflicts about the true nature of trading. Every time you actually do something that confirms your new belief, you will be drawing energy out of the conflicting beliefs and adding energy to a belief in probabilities and in your ability to produce consistent results. Eventually, your new belief will become so powerful that it will take no conscious effort on your part to think and act in a way that is consistent with your objectives. It is vital for us to have a full-blown faith in the ability of our edge to provide us profits over time. In order to build this level of faith, it is imperative that we personally conduct research using historical trading data to build our trading edge. It is not enough to hear from others that a system works. It is not enough to read the summary results from research conducted by others. We must do it ourselves. It is the strength of this faith in our edge that activates a new set of emotions when managing market uncertainty. The strength of the faith in the edge replaces the default negative emotions of fear with positive emotions of confidence and courage. With these new emotions, our mind remains carefree and our thinking brain stays functional. The thinking brain helps in keeping discipline when following our trading plan. The new set of emotions create a mindset that performs effectively under the conditions of uncertainty and capital risk. Randy Howell and Mark Douglas theories reveal consistently winning traders understand, and even more important, internalize that the outcome of a trade is not in their hands. Once they have done their duty, created a trading plan, researched their trading idea, and waited patiently for all signals to align, they know that there is nothing else that they can do, and that, upon entering a trade, they have to accept the randomness of the results. Consistently winning traders know that over the long term, they will come out ahead if they follow their principles and rules, and that in the short term, anything can happen. Therefore, they don't see losses as something bad or something to worry about. As long as they haven't done anything wrong, consistently winning traders do not see a difference between losing and winning trades. Consistently winning traders are process-oriented thinkers. It means they have the ability to trade and act completely detached from the outcome. Consistently winning traders only evaluate their action and behavior based on how well they have executed their trades against their trading plans. This approach removes the emotional ups and downs that come from adding meaning to individual trades, because the results of individual trades don't mean much in and of themselves. It's a great feeling to be able to let go and let the system do its job without freaking and making it personal. Next, let's focus on the trading plan section. A trading plan is a comprehensive decision-making tool for your trading activity. It helps you decide what, when, and how much to trade. A trading plan should be your own personal plan. You could use someone else's plan as an outline, but remember that someone else's attitude towards risk and available capital could be vastly different from yours. You need a trading plan because it can help you make logical trading decisions. A good trading plan will help you to avoid making spontaneous decisions in the heat of the moment. Easier trading. All the planning has been done up front, so you can trade according to your preset parameters. More objective decisions. You already know when you should take profit and cut losses, which means you can take negative emotions out of your decision-making process. Having an effective trading plan helps in controlling negative emotions. The more you can trade without your negative emotions, the more effective you are. Better trading discipline. By sticking to your plan with discipline, you could discover why certain trades work and others don't. More room for improvement. Defining your record-keeping procedure enables you to learn from past trading mistakes and improve your judgment. Focusing on the steps leading to specific results gives you a sense of control over your actions and liberates rather than drains your energy and attention. Formulate a set of rules that you can apply without second-guessing yourself. Learn to distinguish between the right trade and comfortable trade. In fact, the right trade is often uncomfortable. Your personal set of rules will provide the capacity to override your emotional fears. Trading is a profession in which each day you run a new race, play a new game, and take new risks. The risk of loss is constant. The two essential parts of a trading plan are 1. Your trading edge, 2. Money management rules. However, it's a good practice to consider your trading goal in your trading plan, and also include trading diary as part of your trading plan. Let's talk about them in a little detail. Trading goal will be covered more in depth in the next section, but I think it is important to point out the importance of having a trading goal in the context of trading plan. So I will share with you a few thoughts around defining your trading goal. A trader without a goal is like a traveler without a destination. If you are committed to succeeding, you can't afford the luxury of trading what you like on a spontaneous basis. Consistently successful traders set an objective. For example, a percentage gain they want to achieve in a given period, a portfolio total number they wish to reach, and then try to make decisions in line with that vision. Write your goal down. Your head is full of traps. Your mind plays games convincing you that you're okay when you're not okay. But trading success has nothing to do with illusions. It's based on reality. Having your number in writing keeps reminding you of your commitment and helps you get past denials and other psychological defenses. You should also clearly know what type of trader you are. Your trading style should be based on your personality, your attitude to risk, as well as the amount of time you're willing to commit to trading. There are 4 primary trading styles. Position trading, holding positions for weeks, months, or even years with the expectation that they will become profitable in the long term. Swing trading, holding positions over several days or weeks to take advantage of medium-term market moves. Day trading, opening and closing a number of trades on the same day and not holding any positions overnight, eliminating some costs and risks. Scalping, placing several trades per day for a few seconds or minutes in an attempt to make small profits that add up to a large amount. I will use the phrase risk management and money management interchangeably. What are we trying to do when we focus on money management? In simple words, we're trying to manage our money or manage our risk. Our goal is to preserve our capital or hard-earned money. We want to minimize the chance for loss, or, in a larger sense, minimize our risk of ruin. Money management is a crucial element of trading. Money management is about controlling risk by not betting so much that you run out of money before the opportunities present itself. Anything can happen at any time in the markets. Using a sensible money management technique ensures that the trader will be able to trade again no matter what happens. Major reason traders fail, even when using a profitable trading system, is because the money management they use does not give their edge long enough to play out over time. Traders must think like a casino when trading. Casino factors in how much money they can risk, ensuring that, in the end, they will make money. Casinos set table limits so as not to expose themselves to the risk of ruin by allowing a gambler to hurt the casino's bottom line on any one huge bet. This is what traders have to do. To ensure that no matter what happens and no matter what losing streaks they have, they give their profitable trading method time to play out by using a money management technique that keeps them in the game. Here are a few money management questions to consider. Will you have a price target, or will you just leave your profits open-ended? How big of a position size will you take for each trade? What do you want your maximum loss on any one trade to be? Are your stop losses at price levels that will avoid the noise of normal price action and only be triggered when you are proven wrong? How will you use trailing stops to maximize gains? What are your goals for annual returns? What is your maximum drawdown limit? What is your expected winning percentage? What is your goal for risk-reward ratio? How many open positions will you have at one time? How much will be your maximum risk exposure at one time? Will you use margin? How much capital do you need? Look at how much money you can afford to dedicate to trading. You should never risk more than you can afford to lose. Trading involves plenty of risks, and you could end up losing all your trading capital. Do the math before you start and make sure you can afford the maximum potential loss on every trade. If you don't have enough trading capital to start right now, practice trading on a demo account until you do. How much to buy or sell is the single most important aspect of trading. Most beginning traders risk far too much on each trade and greatly increase their chances of going bust, even if they have an otherwise valid trading style. Exits relative to entry determine whether a trade results in a profit or loss, but position size determines by how much. For that reason, position sizing is a significant variable in any system. When used correctly, it can help you manage risk effectively and succeed in achieving your trading goal. A consistently successful trader puts much emphasis on controlling losses. When you keep losses to a minimum by concentrating on ways of reducing losses, you increase the chances of sticking to your strategies and hitting your target. Losses can prompt gambling behavior, where the trader keeps looking to recover all the losses in a few high-risk trades. Sometimes it is absolutely the right thing to do to take a loss, to avoid making much more significant and more catastrophic losses to your hard-earned funds. So you have to prepare to lose battles to win the war. Diversity is good. When you buy a group of stocks or instruments, you reduce your risk through diversification. Diversification is an attempt to spread risk across many instruments and to increase the opportunity for profit by increasing the opportunities for catching successful trades. Proper diversification requires making similar, if not identical, bets on many different instruments. Let's consider this example for drawdowns. Let's say you have $100,000 in your trading account and you lose $50,000. What percentage of your account have you lost? The answer is 50%. Simple enough. This is what traders call a drawdown. A drawdown is the reduction of one's capital after a series of losing trades. This is normally calculated by getting the difference between a relative peak in a capital minus a relative trough. Traders normally note this down as a percentage of their trading account. In trading, we are always looking for an edge. This is the whole reason why traders develop systems. A trading system that is 70% profitable sounds like a very good edge to have. But just because your trading system is 70% profitable, does that mean for every 100 trades you make, you will win 7 out of every 10? Not necessarily. How do you know which 70 of those 100 trades will be winners? The answer is that you don't. You could lose the first 30 trades in a row and win the remaining 70. That would still give you a 70% profitable system. But you have to ask yourself, would you still be in the game if you lost 30 trades in a row? This is why money management is so important. No matter what system you use, you will eventually have a losing streak. The key to being a successful trader is coming up with a trading plan that enables you to withstand these periods of large losses. And part of your trading plan is having money management rules in place. Only risk a small percentage of your trading bankroll so that you can survive your losing streaks. Remember that if you practice strict money management rules, you will become the casino, and in the long run, you will always win. For a trading plan to work, it needs to be backed up by a trading diary. You should use your trading diary to document your trades, as this can help you find out what's working and what isn't. You don't only have to include technical details, such as entry and exit points of the trade, but also include the rationale behind your trading decisions and emotions. If you deviate from your plan, write down why you did it and what the outcome was. The more detail in your diary, the better. And finally, let's talk about the trading edge. Trading edge is not only a very important part of the trading plan, but it is also an important element of the framework. A trading edge is a condition or set of conditions that, when present, give a higher probability of a trade working than not working. Traders always look for an edge, an advantage over fellow traders. Like knights shopping for swords, they are willing to pay handsomely for their trading tools. No price is too high if it lets them tap into a money pipeline. Earlier, I had explained why do casinos make consistent money on an event that has a random outcome. Because they know that over a series of events, the odds are in their favor. They also know that to realize the benefits of the favorable odds, they have to participate in every event. They can't engage in the process of picking and choosing which hand of blackjack or roll of the dice they are going to participate in by trying to predict in advance the outcome of each of these individual events. Consistently successful traders use the same thinking strategy as the casino and professional gambler. Not only does it work to their benefit, but the underlying dynamics supporting the need for such a strategy are precisely the same in trading as they are in gambling. Suppose the trader seizes the opportunity to take advantage of his edge and puts on a trade. What factors will determine whether the market unfolds in the direction of his edge or against it? The answer is the behavior of other traders. At the moment he puts trade on, and for as long as he chooses to stay in that trade, other traders will be participating in that market. They will be acting on their beliefs about what is high and what is low. At any given moment, some percentage of other traders will contribute to an outcome favorable to our trader's edge, and the participation of some percentage of traders will negate his edge. There's no way to know in advance how everyone else is going to behave and how their behavior will affect his trade, so the outcome of the trade is uncertain. Since trades have an uncertain outcome, then, like gambling, each trade has to be statistically independent of the next trade, the last trade, or any trades in the future, even though the trader may use the same set of known variables to identify his edge for each trade. If the outcome of each individual trade is statistically independent of every other trade, there must also be a random distribution between wins and losses in any given string or set of trades, even though the odds of success for each individual trade may be in the trader's favor. Consistently successful traders don't attempt to pick and choose their edges. At the micro level, consistently successful traders believe that each occurrence of their edge is unique. They understand at any given moment the market may look exactly the same on a chart as it did at some previous moment, and the geometric measurements and mathematical calculations used to determine each edge can be exactly the same from one edge to the next. But the actual consistency of the market itself from one moment to the next is never the same. They don't attempt to pick and choose the edges they believe are going to work and act on those, nor do they avoid the edges that, for whatever reason, they believe aren't going to work. If they did either of those things, they would be contradicting their belief that each occurrence of the edge is always unique. They have learned, usually quite painfully, that they don't know in advance which edges are going to work and which ones aren't. They have stopped trying to predict outcomes. They have found that by taking every edge, they correspondingly increase their sample size of trades, which, in turn, gives whatever edge they use ample opportunity to play itself out in their favor, just like the casinos. When you achieve complete acceptance of the uncertainty of each edge and the uniqueness of each moment, your frustration with trading will end. Predefining the risk doesn't pose a problem for these traders because they don't trade from a right or wrong perspective. They have learned that trading doesn't have anything to do with being right or wrong on any individual trade as long as you follow your trading plan. As a result, they don't perceive the risks of trading in the same way the typical trader does. You don't need to know what is going to happen next to make money. Why? Because there is a random distribution between wins and losses for any given set of variables that define an edge. In other words, based on the past performance of your edge, you may know that out of the next 20 trades, 12 will be winners and 8 will be losers. What you don't know is the sequence of wins and losses, or how much money the market is going to make available on the winning trades. This truth makes trading a probability or numbers game. When you really believe that trading is simply a probability game, concepts like right and wrong or win and loss no longer have the same significance. As a result, your expectations will be in harmony with these possibilities. As a result, consistently successful traders with edge stay relaxed because they are committed and willing to let the probabilities, their edges, play themselves out, all the while knowing that if their edges are good enough and the sample sizes are big enough, they will come out net winners. Say you and I decide to flip a coin. When the coin lands on heads, I give you $60. If it lands on tails, you give me $20. In the short term, anything can show up, yes? Even though the bet isn't that advantageous for me, in the short term, I can hit a string of tails and you might end up paying me $80. But, as we keep tossing the coin, you're almost certain to win more than me. So, when playing a probability game, results matter, but they do not matter in the short term. Hence, in trading, if you're going through a string of losses, no matter how bad and painful it may look and feel, it is crucial to remind yourself that this is part of probabilities. If you're trading a proven system, the numbers will eventually work themselves out. No storm lasts forever. When you get attached to short-term outcomes, you freeze your desire into a rigid framework, which interferes with the whole idea of having the numbers work in your favor. Consider the following chart where the market has been identified as a ranging market. The edge in this scenario is that the price is trading in a range. The price is more likely to fall at the upper boundary and rise at the lower boundary. Based on this edge, you can use an indicator such as the stochastic indicator that signals when the price has reached the upper or lower boundary. The stochastic indicates when the upper boundary has been reached, and so, therefore, this produces a selling signal. The stochastic indicates when the lower boundary has been reached, and so, therefore, this produces a buying signal. These trading signals are still based on probability. In other words, if your indicator is producing a buying signal, then this does not mean the price will go up. It means that there is a higher probability of the price going up than going down in the current market conditions. The truth is, once you enter the market with any given trade, you are at the mercy of the markets. This is where a system or strategy comes into trading. A strategy is a set of rules that you trade by, and those rules are based on identifying an edge and then trading accordingly. This means that it does not matter if the trade wins or loses, because if you trade with a strategy based on an edge, then your trading system will produce winning trades over time that will make up for the losses. Building an edge comes through a combination of research and extensive testing. After some initial inspiration gives you an idea for a setup you can potentially integrate into your trading plan, the next step is putting some rules around it. Once you've got your rules, it's time to test and test some more. Run through historical data and do everything possible to approach it the same way you would if the market was real time and you were trading with meaningful size. When a valid trade comes up, don't hesitate. Take it. If it wins or loses, don't worry. It doesn't really matter what the outcome of that single trade is. Even with a strong edge, a single trade always has a random outcome. And even the highest probability setups can and do lose. To really know if what we have is a statistically significant edge, we need to test more than just a small handful of trades. You should look to test at least 20 trades for statistical significance that fit your setup criteria, and then sit back and take a good look at the numbers. Is it producing the desired profits? What about after factoring in trading costs? If everything looks good, it's time to go to the next step, testing some more. Yes, I realize that all this work isn't exactly the sexy part of being a trader, but to build confidence in one's edge, there must be a lot of data to back it up. So repeat the tests of 20 trades using different historical data. If you have run things through 3 times and all of them have shown that your setup has a substantial edge, then you can take things to the next level, which is live trading. This step takes a bit more time because you need to wait for your tested set to come up at least 20 times in live markets. Keep trading the way you did using your historical data, and don't start to become overly conservative or aggressive just because you are now live. This is actually a common mistake made by many new traders. But if you don't trade the same way that you test, what use is all that data? If you've made it through 20 live trades with your setup and you still have the same solid edge, then congratulations. You've just added a new setup to your trading plan. You now have the confidence, both historically and in real time, that this setup will make you money over a set of trades. This is extremely powerful, and it automatically puts you way ahead of 95% of the traders out there who don't put forth the effort to test their trading plan rigorously. Confidence in your trading edge is vital. Recall in the Trader's Mindset section, we talked about creating new beliefs to replace our inherited survival instincts. This confidence in your trading edge will play a paramount role in creation of those new beliefs. Any trader must have full confidence in the ability of their edge to provide them profits over time. Without confidence, a trader becomes far more susceptible to breaking their own rules and making foolish trading decisions. To have this confidence, we need 2 essential things. The first is the large sample of trades we discussed that cover both historical and live markets. With a statistically significant sample that has been properly tested, we can be confident in our positive expectancy over a large set of trades. The second crucial factor is that we can properly execute that tested edge. Just because we have a tested trading plan doesn't necessarily mean that our success is guaranteed. We need the patience and discipline to wait for the setups that fit our plan. And we need to be able to be fully prepared to enter the market when the moment presents itself. So how do we build and refine the mental aspects of our trading edge? In this case, there are a few shortcuts. It simply takes time, discipline, and the desire to improve persistently. Once you have done all the necessary work to have confidence in your edge, all you need now is the patience to wait for those setups to appear. Most people enter trades based on negative emotions, greed, and the fear of missing out. But consistently successful traders enter the market based on their edge. The key here is to have patience. Don't go anxiously searching for trades and willingly allow your trading edge to decrease. Sit back, assess the market with clarity, and attack only when your trading edge presents itself and the odds are stacked in your favor. We have to be rigid in our trading rules and flexible in our expectations. We need to be strict in our trading rules so that we gain a sense of self-trust that can and will always protect us in an environment that has few, if any, boundaries. We need to be flexible in our expectations so that we can perceive with the highest degree of clarity and objectivity what the market is communicating to us from its perspective. At this point, it probably goes without saying that the typical trader does just the opposite. He is flexible in his trading rules and rigid in his expectations. Interestingly enough, the more rigid the expectation, the more he has to either bend, violate, or break his rules to accommodate his unwillingness to give up what he wants in favor of what the market is offering. In the conclusion of this section, I will say a trading plan is like a map for a driver, a playbook for a football coach, or a checklist for a pilot. It's imperative to have a trading plan. That's how consistently successful traders make money year after year. They have a plan. They know where to buy something, where to sell, how much to risk, and why. And they stick to their plan. If you trade, have a plan. It's imperative. And remember, knowing trading rules is not enough to make you rich. You have to be able to follow them. Next, we will talk about the final foundational aspect of trading in our framework: trading goal. You have to have a purpose. Famous American author and motivational speaker Jim Rohn said that if your why is big enough, then the how doesn't matter. What this means is that when your reasons or goals for succeeding are big enough, nothing can stand in your way. You will find a way to succeed no matter what. Developing profitable trading on a consistent basis is difficult, but if you have a big enough goal to succeed, then you will. Trading goal creates a context of possibility, like a canvas providing an artist with a setting in which to paint. The canvas shapes the magnitude and limits of the painting and sets the boundaries. Select a challenging goal, and then, within the frame of the goal, decide what you must do to trade at that level. Once you choose a goal, you will notice it gives you direction and helps to organize your time and your resources so that you can achieve what you set out to do. More than most disciplines, you will need to be 100% clear on your goal to be successful in this trading. Without clear goals, you will not succeed in trading, period. If you don't have these goals clear, it is impossible to know when your trading system is sufficient. You will also not know if your trading results are meeting your goals once you actually start trading. With no clear outcome to work towards, there is no way of knowing when to stop, nor what needs to be optimized. Your trading goal impacts everything you do in trading. Use trading goal as a lens for making decisions in the present, rather than a target to reach. Trading goals are just one aspect of setting objectives for your life. It is crucial to have your trading goals clear and in writing. But if you have no idea how these fit into the rest of your life, then you will likely struggle to find the motivation and discipline to succeed in your trading business. When thinking about your goal, imagine what it will do for you or enable you to do, and how it will increase your ability. As you begin to consciously choose your own trading goals, you will notice how much of your life has been focused on pursuing unconscious goals conditioned in childhood. You will learn how much more satisfying things can be when you begin to actively pursue consciously chosen goals. The difficulty most people have is that the goals that drive them are not conscious. If goals are not conscious, then we are not really aware of what we are working towards or why we do the things we do. If you have no written trading goals, then you are in extreme danger with your trading because you are being driven by subconscious goals. These are very unlikely to support consistently successful trading. Read a range of trading psychology books, and you will see that these subconscious goals are likely to be something like this. 1. Desire to be right. Desire to be right causes you to cut winners early and hold on to losses in the hope that they will turn around. This reduces the size of your average winning trade and increases the size of your average losing trade. 2. The desire for excitement. The desire for excitement causes you to overtrade or trade too frequently. and take poor trades just to give you some action. The desire for excitement may also cause you to excessively monitor your trades, wasting time, increasing stress, and increasing the risk of mistakes. 3. Social acceptance. Social acceptance causes you to discuss your positions or performance openly, leading to emotional attachment to positions, stress about your performance, and the giving or taking of tips or advice, which can undermine the integrity of your trading system. 4. Avoidance of pain and discomfort. Avoidance of pain and discomfort causes you to not take actions that may lead to pain, such as taking a loss. If you are unwilling to incur a little pain now, the situation could deteriorate and become a much larger pain in the future. Avoidance of pain and discomfort also causes you to cut winners early and hold on to losses in the hope that they will turn around. This reduces the size of your average winning trade and increases the size of your average losing trade. Keep your dream to yourself, or gingerly share it with only those you can trust to nurture it. Don't dilute your goal by sharing it with the wrong people or seeking reassurance. Protect your vision, and don't share it with anyone who would discourage you, however well-intentioned they are. Again, trading goals need to be written down and revisited regularly to keep you focused on what you are trying to achieve with your trading system as you go through the trading system development process. The tools you will use to achieve your trading goals are your willingness and desire to learn, fueled by your passion to be successful. If the willingness and desire to learn are your primary tools, then what is your medium? An artist creating a sculpture can choose to work in many mediums: clay, marble, or metal. But if you want to create a new version of your personality that expresses itself as a consistently successful trader, you have only your mindset. The medium for your artistic endeavor will be your mental environment, wherewith your desire to learn. You can restructure and install the beliefs and attitudes that are necessary to achieve your ultimate goal. In conclusion, I will say the market does not know you exist. You can do nothing to influence it. You can only control your behavior. A sailor cannot control the ocean, but he can control himself. He studies currents and weather patterns. He learns safe sailing techniques and gains experience. He knows when to sail and when to stay in the harbor. A successful sailor uses his intelligence. An ocean can be useful. You can fish in it and use its surface to get to other islands. An ocean can be dangerous. You can drown in it. The more rational your approach, the more likely you are to get what you want. When you act out your negative emotions, you cannot focus on the reality of the ocean. The same is true about the trader and the market. That's it from me. Thanks for watching. I hope this video has been helpful. Good luck with your trading. If you have any questions, feel free to leave them in the comments below. If you like this video, please hit the subscribe button below so you're notified when a new video is published.